In this week's market update, Brexit deal could be within sight, UK new car sales stalling, and US unemployment at lowest level since 1969. With less than 6 months to go till we leave the EU on March the 29th, Brexit continues to dominate the headlines. It's also at the forefront of investors' minds too. Comments by senior EU officials on Friday have raised hopes that a deal is within sight. Jean-Claude Juncker, the head of the European Commission, said the chance of the UK and the EU reaching a deal has increased in the last few days and could be agreed by November. Speaking to the Austrian press on Friday, he was asked whether an agreement could be reached at the next meeting of European leaders on the 17th of October. Mr Juncker said, "We are not that far yet, but our will is unbroken to reach agreement with the British government." Meanwhile, European Council President Donald Tusk said an agreement was possible by the end of 2018. However, this was played down by Downing Street yesterday, with a spokesman for Number 10 insisting big issues still need to be resolved, with questions still remaining on future economic cooperation and the Irish border. Markets welcomed the news, with the pound soaring to a 3.5-month high against the euro yesterday. Sterling first saw gains last week following Theresa May's rallying speech during the Conservative Party conference, where she warned that Britain wasn't afraid to leave with no deal if it had to. Meanwhile, Britain's position of strength in a post-Brexit world has been heralded by comments from Japanese Prime Minister Shinzo Abe. Mr Abe said in an interview with the Financial Times that while Brexit would mean the UK loses its position as a way into Europe, it would still remain a country equipped with global strength. And he added that Japan would welcome Britain to the Trans-Pacific Partnership trade deal with open arms. The Trans-Pacific Partnership is a trade agreement between 11 Pacific countries, including Japan, Australia, Canada, Mexico, Malaysia and Vietnam. It would give the UK entry into a large and fast-growing part of the world economy. This is a positive move, but one that will only be possible if the UK leaves the EU's customs union and regains the power to set its own tariffs. However, his remarks will give a boost to Brexit supporters by helping to paint the picture of a positive Britain post-Brexit. It also provides some calm to businesses worrying that the Brexit deadline is fast approaching without a deal in sight. Japanese multinationals such as car manufacturers Toyota and Nissan and electronics manufacturer Panasonic all use their British bases as a route into Europe. Last week, Nissan became the latest manufacturer to warn against a hard Brexit. The Japanese car maker that employs almost 8,000 people in the northeast said frictionless trade has enabled the growth that has seen our Sunderland plant become the biggest factory in the history of the UK car industry, exporting more than half of its production to the EU. This comes at a time when car companies are already struggling with uncertainty over the future of diesel. Sales of new cars in the UK fell by 20% in September, according to figures by the Society of Motor Manufacturers and Traders. September is traditionally a bumper month for sales as consumers rush to buy cars with new number plates. However, last month was the worst September for car sales since 2008, when the UK was in recession. To add further to the gloom, Jaguar Land Rover is planning a 2-week shutdown of its Solihull plant at the end of October. The company blamed weakening global demand, especially in China, and has suffered from falling diesel sales recently. Thankfully, they also confirmed that employees would still be paid during the shutdown and no jobs would be lost. In other news, across the Atlantic, US markets appear to be pausing for breath following the recent highs. Last Friday's US employment numbers were below expectations. Jobs were still added in the American economy, but not at the rate analysts were expecting. The US unemployment rate has fallen to its lowest level since 1969, further demonstrating the strength of the US economy. This could pave the way for faster than expected interest rate rises. However, the latest wage figures showed less inflation pressure than had been feared. Last month, the Fed raised short-term interest rates for the 8th time since 2015 and indicated that there would be further increases consistent with sustained expansion of economic activity. Looking ahead to this week, it's the turn of the Scottish National Party to host their annual conference in Glasgow. Nicola Sturgeon has said the party would back a new Brexit referendum if it was put to them, and their MPs would oppose anything short of staying in the single market and customs union. In company news, the recruitment and staffing sector is in the spotlight this week, with results due from Page Group and Hays. The recruitment sector is a useful bellwether for assessing the state of the UK economy. At the end of August, Hays reported only 2% growth in its UK and Ireland division amid an uncertain market. Page Group also talked about weakness in the UK division, but turned in an overall 18% rise in first half profits on the back of a strong performance thanks to its offshore operations. We're also due an update from WH Smith on Thursday as they announced their full year results. WH Smith was given the unfortunate title of Worst UK Shop in a Which survey earlier this year. However, its travel outlets at airports and stations are in a different league. Here, business is buoyant. The firm opened 8 stores at Madrid Airport alone in August and also opened the first of 6 stores in Rio de Janeiro. The company now has 286 stores internationally and says it continues to see further opportunities in the international news, books and convenience travel market. Finally, with less than 3 weeks to go before the autumn budget, the Chancellor is under pressure to help the housing sector, especially for first-time buyers. According to new research, about 40% of young adults cannot afford to buy one of the cheapest homes in their area, even with a 10% deposit. The Institute for Fiscal Studies said house prices in England have risen by 173% over the last 20 years. Over the same period, the average pay for 25 to 34-year-olds has grown by just 19%. The IFS also said that higher rental costs have reduced the purchasing power of young adult incomes and made it harder to save for a deposit. Onward, a centre-right think tank, has suggested the government should give UK private renters a chance to buy their own homes by rewarding landlords with 100% capital gains tax relief if they sell to a sitting tenant who has lived there for at least 3 years. The Chancellor is also under pressure to support struggling high street retailers, with Tesco's Chief Executive Dave Lewis calling for a new digital sales tax. Dubbed the Amazon tax, in an interview with the Mail on Sunday, Lewis urged the Chancellor to impose a 2% charge on goods sold online. Lewis believes this would raise £1.2 billion and could be used by the government to help ease the pressure on high street retailers by cutting business rates. That's all for this week. Join us again next week for more market news.